The Greeks will really help you out in terms of understanding how you actually make money when trading options. Now, there's going to be 4 different Greeks that we're going to talk about here in today's video, and I'm going to use ticker symbol RIVN to take you through these Greeks. So let's just get right into this video, guys. Let's go into the options here for Rivian Automotive, and let's just take a look at one of these options. So I'm going to leave my expiration date as July 29th. And I'm going to start by taking a look at this call option right here at the 32.50 strike. So remember, you can click on this option and it's going to expand and it's going to give you a lot of different information here. And again, today we're primarily focused on talking about the Greeks. So as you can see, there are 5 different Greeks. We're only going to talk about the first 4 because these are really the only important ones. Row isn't that important, okay? So we're going to go in order here. We're going to start with Delta. So Delta here, as you can see, which is one of the Greeks, Delta measures how much an options price can be expected to move for every $1 change in the price of the stock. Now, when it comes to calls, Delta is going to be a number between 0 and 1. When it comes to puts, Delta is going to be a number between -1 and 0, okay? And so let's take a look at an example and understand how this works, okay? So first things first, guys. When it comes to the Greeks, you need to multiply it by 100 to get the true value, similar to what you need to do to get the true value of an option. Because remember, an option represents 100 shares. Each value you see here for the Greeks, or even for the value here, the price, that represents for 1 share. And again, there's 100 shares in each one of these contracts. So we do need to multiply all of these by 100 here. So the real delta here is 51.67. And here's what it means. It means that if the share price of Rivian were to go up $1 right now, the value of this option would increase by whatever delta is, which again is 51.67. So that means if you buy this call and the share price of Rivian goes up by $1, your contract will go up by $51.67. Or in other words, you would have made a profit of $51.67 so far. Now, on the other end, it's also the same thing though. If you buy this call right now and the share price of Rivian drops by $1, the value of this option will lose whatever delta is. So if the share price of Rivian drops $1 right now, the value of this option would go down by $51.67. So in other words, your total return would be negative 51.67 so far, okay? So that's how delta works. And that's basically the biggest way you're going to make money, right? When you buy a call, you buy a put, you hope the share price goes up or the share price goes down. And this, again, will tell you how much you can expect for every $1 change in the price of the stock. Now, the other thing that I want to mention here before we take a look at puts here is that if you go further in the money here, right? So for example, if we take a look at the call at the $22 strike, which is in the money, right? This is an in the money call option. Notice that delta now is closer to 1. So delta here is 0.9882. So now if you were to buy this call and the share price of Rivian goes up by $1, you would make $98.82. You would make more than if you bought the first call I showed you at $32.50. But again, same thing. If it were to drop $1 right now, you would instead lose $98.82 right away. So as you can kind of see, you kind of have to determine which strike you want to choose here. And delta, of course, is one of those things you can look at. Now, if I go further out of the money, for example, if I look at the $40 strike, right, which only cost $5, look at delta here, 0.0359, right? So if I buy this call and the share price of Rivian goes up by $1, you're only going to make $3.50. you're not going to make nowhere near as much as if you were to choose the in the money call option. But same thing, right? If Rivian goes down by $1, you're also only going to lose $3.59. So you're not losing as much. So again, always keep an eye out for Delta. Very important Greek here. Now let's quickly take a look at how this works for puts. So if I switch over to puts now, and let's take a look at the same strike here, 32.50. Notice here that for puts, Delta is negative, right? It's a negative value here. And this makes sense, right? Because when it comes to puts, you don't make money if the price goes up. You make money if the price goes down. So it's the same concept, but now you kind of have to reverse it. And like I mentioned, Delta here for puts is going to be between -1 and 0. So now, if the value or the share price of Rivian goes up by $1, you would basically be adding what Delta is, or in other words, you would subtract, because this is negative, 48.31, right? So if you buy this put and the share price of Rivian goes up by $1, the value of your put would drop by $48.31. But similarly, right, if the share price goes down, now you want to subtract Delta from the price, but since Delta is negative, you would be adding it to the price. So if the share price of Rivian drops $1, the value of your option will increase by $48.31. So that's how Delta works. That's how you can take a look at how much you can expect to potentially make for, again, every $1 change in the price of the stock. Now let's go back to calls here. And the next thing I want to talk about here is gamma, right? So we're going to move on to the second Greek here. So gamma measures the rate of change in an option's delta over time. So more precisely, gamma here is going to be the rate of change in an option's delta per $1 change in the price of the underlying stock. So delta is always changing, and I showed you it, right? I showed you this example. I showed you an example where delta was 0.98, and I showed you an example where it was 0.03. Delta is always changing. And what lets us know how much it's going to change by? That's this Greek, gamma. So basically, right, the way this works is if the share price of Rivian goes up by $1, then delta is also going to change as well, and it's going to change by whatever gamma is. So basically, it would go from 51.67 to 51.67 plus whatever gamma is, which is going to be 12.51. So if the share price of Rivian goes up by $1, our new delta would be 0.6418, okay? And the same thing if it were to instead drop by $1, right? If the share price were to drop by $1, then the new delta would change. The new value of delta would be 0.5167 minus 0.1251, right? That's how that works right there. So that is gamma, and so that's how delta and gamma kind of fit in together. Now let's go ahead and move on here to our third Greek. So the third Greek is theta. So theta tells you how much the price of an option should decrease each day as the option nears expiration if all other factors remain the same. And so this kind of price erosion over time is known as time decay. So this is a very straightforward and simple Greek, guys. Again, this tells us how much we can expect the value of this option to lose every single day just from time passing by. And so it's negative, right, because we're losing money here. So for example, for this call option, if you buy this call option and then one day passes and everything else remains the same, implied volatility remains the same, the share price remains the same, you can expect the value of your option then to decrease by whatever theta is. So basically, if I buy this call, I hold it for a day, nothing changes, I can expect my call to lose $12.53 in value. So again, when you're buying calls, you're buying puts, that's not good because this is going to decrease the value of the option. When you're buying options, you want the value of your option to go up. Now, if you're selling options, it is good for you because when you sell options, you do want the value of the option to go all the way to 0. 0 so that you can basically close out for 0, for $1, whatever it is, right? So always check for theta, guys. And keep in mind that the more in the money you go, theta is going to be less. So if you take a look at theta, right, 0.03, as you can see, it really changed. And also the further out of the money you go, theta is also going to be less. So as you can see, 0.015, right? So theta is going to be the highest with the at the money options. And so remember, at the money options are the options whose strike are as close to the current share price, which this would be the at the money option. And as you can see, it has a theta of 0.1253. We take a look at this one, right? It's also going to have a high theta. And then again, the more out of the money you start to go, or the more in the money you start to go, theta will become less and less. But always be aware of theta. I think that's one of the biggest factors that cause a lot of people to lose a lot of money without them even knowing about it. So that is theta, guys. Now we have one more Greek here that we need to cover, which I think is maybe the most important one, because implied volatility can really go crazy, okay? So the next Greek, the fourth Greek here, is going to be Vega. Okay, so here's Vega. And again, all these values should be multiplied by 100 to give you the true value. So Vega here measures the rate of change in an options price per 1% point change in the implied volatility of the underlying stock. Again, this is one of the most important factors that affect the value of an option, because a drop in Vega will cause both calls and puts to lose value, sometimes a lot of value. However, an increase in Vega will cause both calls and puts to gain value. So let's take a look here at the way this works. So basically, for every 1% increase or decrease in implied volatility, the value of this option will increase or decrease by whatever Vega is. So let's say you buy this call and implied volatility goes up by 1%. The value of this option then will go up by whatever Vega is, which again, if we multiply this by 100, we would get $1.53. So if you buy this call, implied volatility goes up by 1%, the value of your option will go up by $1.53. So basically, you would make a little bit of money, right, for a 1% increase. However, the same is true for a 1% decrease. If if implied volatility drops by 1%, then the value of this option will go down by whatever Vega is. So if implied volatility drops 1% right now, and you were to buy this call before that, then the value of your option will go down by $1.53. Now, that also means, for example, if, let's say, instead of implied volatility going up by just 1%, let's say it goes up by 10%, then the value of this option would go up by whatever Vega is times 10. So that would be $15.30. So if you buy this call, implied volatility goes up by 10%, then the value of your option will go up by $15.30. So the new value of the option would basically be $146. However, if you buy this call and implied volatility drops by 10%, the value of this option would drop by $15.30, or the new value of the option would be $116, which, as you guys can see, if implied volatility really changes a lot, and sometimes it changes by 100%, 200%, either way, right? If it goes up by 200% or it drops by 200%, that's going to be a huge change in the option. Even if the price doesn't change, even if time hasn't passed by, just from implied volatility having a massive change, that can really affect the pricing of an option. And that's why I believe this is one of the most important factors that affect the value of the options. This is a very common question I get asked. Hey, I bought a call, it even went up in price, but the value of the option actually dropped in price. It's probably because implied volatility dropped 10, 20, 50, 100%, and the value of your option then, of course, lost a lot of money, right? So these Greeks are very, very important. They're something you should always look at prior to even buying the call or buying the put, or if you're selling options. You should always look at the Greeks and truly understand what you're getting yourself into, okay? Because again, these right here are what are going to affect the value of the option here. So anyways, if you guys have any questions about anything I just talked about, feel free to leave them in the comment section below. Hope you enjoyed the video. Let me know what you guys think, and I will see you guys next time.